one of the key reasons why I remain bearish on the dollar is I think the Fed at the next FOMC is going to sound more dovish than the market thinks. The backdrop is two things. One is if you look at the US economy, yes, there's been 9 million jobs that have been recouped, but there's still 13 million people that have not found new jobs. So the economy, the Fed's so far away from its dual mandates of 2% inflation and full employment. But the other thing is this COVID crisis is probably going to exacerbate secular stagnation. Things like income inequality, the uncertainty about the future is pushing savings up and investment down. And so the real interest rate is probably going to go, the real neutral interest rate is probably going to go negative. So the Fed has to do more. And I think we are going to see things like average inflation targeting, open-ended QE, more aggressive, enhanced forward guidance. All these things I think are going to drive the real interest rate across the curve even more negative, and that's going to weaken the dollar. The one thing I'd say that worries me is against the dollar is who strengthens against the dollar. And it could be that the euro takes a breather, because I do worry about this second wave that's starting to develop around COVID cases in Europe. So it could be more in Asia, and particularly the renminbi, dollar going lower against CNY. That could be the kind of bigger move in the coming months.
But just picking up on your points, if you are on your point as far as real interest rates are concerned in the US, if they are headed lower, what would that mean for the 10-year benchmark treasury yield, which till last week was seeing a bit of a spike?
It has gone up a bit, and I think that's something the Fed does not want to continue, because the economy is so weak. But the other part of it is there is just a tsunami of government bond issuance that's going to be coming through, and the Fed wants to very firmly be on the other side of that and really assist the government in keeping sovereign borrowing costs low. So, as I said, I think these innovations by the Fed, and they're very big innovations, I think we'll see the 10-year yield reverse and potentially test new lows after the September FOMC. So it'll be partly that, and also be inflation expectations going up, driving the real interest rate more negative.